This is David Goldman, Asia Times Deputy Editor, speaking to you from New York City the evening of May 3rd. Well, inflation's busting out all over. You will recall that we were inflation bears before inflation was cool, and now we're seeing panicky, if not hysterical, discussions of inflation coming pretty much from all quarters. A Bank of America strategist, for example, clocked the number of mentions of inflation in corporate reports and concluded that at least transitory hyperinflation is in the works. Their words, not mine. The price of used cars, one of our favorites, it's now up 50% year on year. Why? Well, the semiconductor shortage is likely to last for years, according to the CEO of Intel. Rental agencies can't find new cars because the semiconductor shortage is shutting down car production. They're buying used cars, and the price of used cars at auction is now up 51% year on year. Price of transportation, according to the Cass Freight Index, volume is up 10%, but the price of transportation is up 27%. That's a 17% price hike year on year in the cost of transporting pretty much anything. And then you've got instances of shrinkflation. A number of websites point out that Costco is now selling rolls of paper towels at the same price, but with fewer sheets. And that works out to about a 15% price increase for paper towels. So it goes across the board. What does that mean? Well, if you look at the chart of the day, you'll see that we've had a rise in bond yields, particularly the component of bond yields that compensates investors for higher future prices, as well as a fall in the dollar. There are three things that can happen. One is, as inflation increases, the dollar gets cheaper to reprice everything for foreign investors who we need to finance our mammoth treasury deficit of trillions of dollars a year. A second thing can happen is that bond yields go up, particularly the inflation component of bond yields, to compensate investors for the loss in the real value of future coupon payments. And of course, the third thing that can happen is that output will fall. That happens when consumers and producers alike balk at higher prices and simply stop buying. That hasn't happened yet, although we're seeing a bit of deceleration in what some have called a red-hot economy. What do you do with your money? Well, there are several things you could do. One is short bonds. Buy some of the ETFs that move inversely to bond prices. There are several of them. I think that's a good hedge. A second thing is buy foreign assets, European and Asian stocks. And a third is to buy U.S. stocks that do relatively well in an inflationary atmosphere. My two favorites would be the major oil companies, which are still cheap relative to oil prices, and the major banks. Banks like inflation because that tends to steepen the yield curve, that is, push up long rates faster than short rates. Since banks borrow short and lend long, they do well in a steepening yield curve environment. And there are a number of other possibilities, but that's basically the classic solution. Of course, buying houses is a traditionally good hedge. That works until interest rates really move up a lot, at which point it's hard for people to get mortgages and house prices come down. This is David Goldman speaking to you from New York City on May 3rd.